I want to talk a bit more about the financial situation because I think that underlies the political situation, particularly the PC multicultural craziness. I don't think that the PC multicultural craziness is going to change. Well, the reason I think it is not changing is because the financial economic situation is likely to continue for a while. What I want to do, so I want to analyse that, I want to talk about that, not in order to be nerdy, but to help you work out how things are going to change and when, so that you can prepare for it. And also because there's a lot of nonsense talked about by people saying nothing's ever going to change, it won't work, there's nothing you can do, we've lost, it's all going to continue forever. And other people saying, oh, don't worry, it's going to change next week, it's all going to break down next week, next month, next year, it's so crazy it can't continue forever. Well, it may be crazy, but that doesn't mean it can't continue. And if I had a pound for every person who said, "Oh, the next few months it's bound to change. You're just too pessimistic. It's going to change next month. You believe me." But if I had a pound for every person who said that to me, I wouldn't need to come and ask people to fund the moss busting that I do. Okay, the financial situation matters in itself, partly because it's about money, but partly because the PC multicultural craziness is happening because politicians are doing it. Politicians are doing it because we let them. They want to do it and we're letting them do it. We're letting them do it because we put our own financial survival before civilization. That's just what we're programmed to do. That's just the way we are. We put survival first. And in a big state, welfare state, survival means the continuation of the state-managed economy and the welfare state, the state-managed welfare state continuing to pay out. Well, we think it will. I think it's a bit of a scam. I think this idea of pumping money into the economy to create boom, that massively enriches the already rich, quite a small minority. And then a bit of that money comes back in terms of welfare. The people who really gain are the people at the centre of it, who are the politicians. They gain power over business, particularly large business, that they can negotiate with, that they can legislate over, that they can deal with, and also they gain control over us by buying us off through welfare freebies. But that situation is likely to continue for a while. And that means it's unlikely to break down for a while because the underlying financial economic conditions are likely to continue for another few years. Those financial economic conditions, those are likely to break down because they get pushed too hard. And the reason for that, I think, is because of underlying political considerations. So what I'm saying is that the PC multicultural craziness tends in large part to sit on the economic factors. As long as the economy is continuing, we will be prepared to be bought off and to allow the PC multicultural craziness to continue. That financial system of central banks printing money and lending it into the economy by buying up mortgages or buying up government bonds, that is being pushed because governments want to create permanent economic boom, so they can say, look how the economy is booming, look how your employment prospects are booming, and so they can continue taking tax revenue to pay out in welfare freebies that we like. And so at bottom, the problem is not in the politicians, it's not in treacherous elites. They're certainly a linchpin, or the linchpin of it, but the underlying problem is in us. We are the problem, particularly our degenerate and self-defeating belief that the state can, should and will take care of us. That belief is likely to eventually to collapse the economy, which will in turn collapse the system, the state system, the state setup, which will in turn collapse the PC multicultural craziness, which is part of the current state system. You see it everywhere. You see it in advertising, movies, TV, political statements, every aspect of culture. It's all pervasive, but that is likely to continue for now. The reason, because the financial economic situation is looking like it will continue, I think, for another 5 or 6 years. And to illustrate that, what I want to show is two things. The rise in asset prices, so house prices and share prices. Secondly, that this is likely to continue because governments are pledging more. They're saying they're going to spend more. They are looking at it from that philosophical, political point of view, and because inflation doesn't look like it's going to come along. Again, you're getting a lot of people saying inflation is just around the corner. It's going to send interest rates rocketing, which will implode the debt bubble. No, I don't think inflation is coming for a while yet. Not for another few years at least. So I want to deal with the first of those things, asset prices, and those break down into two things, house prices and share prices. If I look first at house prices, let me just do this so you can see that. I want to show you some charts. I look at the American economy, primarily because the American economy is so big, it tends to dominate the world economy, but also because the US dollar is the reserve currency of the world. So where the American economy goes, the rest of the world economy tends to follow. So I'm looking at American house prices here, and the measure that tends to get used is the Case-Shiller index. I'll leave a link below, a Wikipedia link. You can find out about the Case-Shiller index if you want, if you're nerdy enough. But the Case-Shiller index, it measures single home prices in the States, and it tends to be seen as reliable because it tends to focus on repeat sales of the same property. So what did this house sell for 3 years ago? What did it sell for 1 year ago? What did it sell for last week? So they tend to compare like with like. Now, if you look at this chart, this shows house prices in the States. Okay, so in 1987, the average single home was just under $64,000, and in January of 2021, it was just over $236,000. And you can see that curve. That is an all-time high in US house prices, getting higher faster, accelerating away. You see that, the end of that line getting steeper, and you can bet in the last 3 months since January, that has got steeper still. So that is an all-time high in house prices in the States. House prices are rising, looks like they're set to continue rising. So that's the overall historic chart. The year-on-year increase, that is rising as well. You can see there, 2017-18, it was about 5.5%, 6.5%. Then it went in 2019, it went down to about 2.5%, 2.25%. It went down there. That was nothing. That was before COVID. That was simply because the central bank was starting to reduce the amount of money. The Federal Reserve, the American central bank, was reducing the amount of money that it was printing and lending into the economy. And of course, that affected asset prices. There was less money going into houses or going into share prices. So those prices started to slow down. And you saw the right going from 6.5% down to about 2.25%. And then in September of 2019, again, months before COVID, there was a panic in the US markets, in the repo market, which is sort of banks lending to each other. So the central bank went in, printing and lending more money into the economy, increasing the amount of money into the economy by lending it to big banks and to central government. And lo and behold, house prices took off again. And then you had the coronavirus pandemic, a lot of money, coronavirus aid money going into the economy, stimulus checks, stimmy checks going in, and a lot of that money, it didn't go into productive assets. It simply went into boosting asset prices. It didn't go into creating value. People just went and bet the money on the stock market, or they bet the money on house prices. And there you see currently in January, you saw that that's the annual increase in house prices. So year on year at the moment, in January, house prices were going up by over 11% per year. I bet that's higher 3 months later. 3 months later, maybe it's nearer 12% per year that house prices are going up. That is house prices rocketing away. Okay, and that has real world effects. That unfairness. You might think, well, goody, I've got a house. My house is going up. The real people who gain are the people who own lots of houses, big landlords or big investors in houses, big house builders. people who own funds that invest in housing, and the ordinary and people who are already wealthy. That has real world effects. You can see that if you look at there's a little story that brought this to light for me. It's a Danish story, but I'll bring it up. It's this has gone through Google Translate. If you look at this story, huge profit, selling for double-digit million. Okay, this is a lady. She was a Danish pop star in the 80s. I've never heard of her. Apparently she had a single that was a big hit in Japan, made a load of money. And her daughter Mikkelsen. Okay, and what it says is 6 years ago she bought a house for 6.9 million Danish kroner. There's about 8.5 Danish kroner to the pound. And then a few weeks ago she sold that same house for 16 million kroner, about 2.25 times the value. So in 6 years that house went up 2.25 times. She did nothing nothing productive to get that money. She sat on a nice asset that she was enjoying, and all this money got pumped into the economy. That money had to go somewhere. It didn't go into anything productive. It just went into boosting the value of capital assets, which are owned by rich people. Poor people don't own capital assets. That's why they're poor. So if you live in Denmark and you're doing something useful, something valuable, something that people need, let's say you're a medical secretary and you're working hard, underpaid, what you see is your wages have not gone up. Your productive labour is not valued. All of that money that's getting printed and lent into the economy, that's not going into your wages. That is going into capital assets, fixed assets that can act as security for loans. And what you're seeing is your rent going up. You live in a rented property. You're not seeing any gain like that. You're seeing your expenses, your month-by-month expenses going up as your rent goes up. You are getting poorer as a result of this. But if you already have some money because you wiggled your bum on a TV show and sang a song that was a hit in Japan, well, you're then you're rich just because you've sat on a house. That's the kind of unfairness. That creates the point of view which says, productive labour, forget about being productive, forget about creating value, money makes money, gamble, speculate. It is unfair, get in on the unfairness. That unfairness, that doesn't end well. And that idea that just money makes money, that creates a sense of injustice. But that is likely to continue for, I think, another 5 or 6 years. So the other type of capital asset that's rocketing away in value, that is stocks and share prices. Now you can see how that's rocketing away if I show you the Dow Jones Index. That is the measure of the US stock market. If I go to the max, I'll zoom in slightly there. What you see is, I'll zoom out again. What you see is that it goes back to 1981. It was at 1,000. That was the Dow Jones Index, and today, or April 2021, it's 30, a bit over 33 and a half. Okay, so that has gone up 33 times since 81, and that is at a record high, going from one record high to another. And you see that line, it's getting steeper and steeper. Share prices are rocketing away. Now that you might say, well, doesn't that mean you should just join the crowd? You can't beat them, let's join them. I'm not going to advise you. I'm not a financial advisor. You shouldn't take financial advice from me or anyone else off YouTube. But I won't be getting into that. I don't think it's right investing in bubbles. I think it's gambling. You're asking to lose your shirt. And most people do, because you say, I'll get in on this bubble, but I'm lucky, I'm good, I'll get out before everyone else does. The likelihood is you'll be like 99% of everyone. You'll be one of the 99%, and you won't get out ahead of before the bubble reaches the peak. You'll get out after it's reached the peak, and you'll be stampeding to get out of the door, losing everything along with everyone else. So I think participating in bubbles is a bad idea. Okay, but I think that bubble is likely to get into it if you want. I reckon that bubble is likely to continue rising for some time yet, for some years yet. And part of the reason is what you're getting is an increase in what's called in margin debt. Margin debt is when people borrow money in order to buy shares. They say, I can't afford to buy shares, or I want to buy more shares than I could ordinarily afford. And so people borrow money, buy shares with that borrowed money, and they use those shares as security for the money they've borrowed. And that really does push the stock market when people start borrowing money to put it in, to buy shares with it. And you get more and more of that if central banks are printing money and lending it out cheap at low interest rates, to banks who then look for people to lend it to at low interest rates. People will be very tempted to borrow that money and to buy shares with it and watch the share price going up. And that is driving stock market prices. Now, if you look at this chart, that chart of total margin debt, what you have there is in 2010, it was about, I don't know, 260, 270 billion dollars borrowed to buy shares with. Today, that's about, I guess, 810, 820 billion dollars borrowed in order to invest to buy shares with in the US stock market. That is an upward curve. It's going up sharply there. And if I quote from this Wall Street Journal article, investors big and small are driving stock gains with borrowed money. The past year's rally has been boosted by Robinhood day traders and big investment firms. Okay, and the text says the everything rally. That means all assets are increasing in price. That normally doesn't happen. Normally, government bonds, if they go up when the share market is going down. When the share market's going up, government bonds go down. People's money goes into shares and out of government bonds. So it's either one or the other. Similarly with house prices, they tend to not to correlate with government bonds. But everything, house prices, government bond prices, share prices, everything. There's a rally in everything because of all the money that's getting printed and lent into the economy. It's boosting all asset classes. So it's sometimes referred to as the everything bubble. The everything rally that started in stocks last year has been boosted by investors betting money they have borrowed. That includes both small players like the day traders on Robinhood Markets Inc. That's an app you can get on your phone in order to invest in, to bet on the share market with, and heavyweights like Arch, Egos, Capital Management, the investing firm that triggered a mini meltdown for several companies' stocks. Okay, so that is that is margin debt going into the economy. That doesn't end well. That asks for a collapse. What happened in 1929 is everyone wanted to get into the stock market. People were getting told, there's no excuse for you being poor because the stock market will only ever go up. That's what we're hearing again today. People borrowed a lot of money to get into the stock market. Stock prices went down a little bit. People had to get out and sell their shares in order to pay off the loans they borrowed the money with. Otherwise, they'd lose everything else. And then you got a big stock market crash. I think that will happen here, or that will happen now. But I don't think it's going to happen for some years to come. I think this everything rally is likely to continue for some years to come. And the reason I think that is because governments are in a mood to continue to get their central banks to print money and to lend it into the economy, and they will be able to do that for some years to come because inflation is not going to kick up for some years to come. You probably hear people saying inflation's around the corner. I don't think it is. I don't think that's likely to happen. Now, people are going to continue believing that share prices will only go up. They're going to continue believing that for some years to come. Now, what I want to look at is what government's attitude is. Well, the central bank in America, the Federal Reserve, the Fed, they're saying we're going to keep doing what we're doing. And what they're doing is printing money, lending it into the economy. They lend it into the economy basically at the moment in two ways. Firstly, they buy mortgages from big banks. So a big bank lends money in the form of a mortgage, and it sells that mortgage to the Federal Reserve. So that's effectively the Federal Reserve lending money into the economy. The other way is the Federal Reserve buys government bonds. So a big bank buys a bond from the American government, the Treasury, and then that big bank sells that bond to the Federal Reserve, which is effectively the Federal Reserve lending money to the American government. And the Federal Reserve is going to continue doing that. Fed officials pressed promise of complete recovery before punch bowl disappears. Okay, the punch bowl means printing and lending money into the economy. So top Federal Reserve officials continued a barnstorming effort on Thursday, that was a couple of weeks ago, to tell investors and the public at large that the US central bank's expansive support, that means expanding the money supply, for the economy will stay in place until an accelerating recovery reaches all levels of American society and is effectively complete. It won't reach all levels of American society. Effectively, I think they're saying they're going to keep doing that forever. Okay, now, but these are senior people in the Federal Reserve basically saying, don't worry, we're going to keep pumping money into the economy. The Fed chair, Jerome Powell, said the change in monetary policy would happen very, very gradually over time and with great transparency when the economy has all but fully recovered. And if that wasn't enough, the vice chair of the Federal Reserve, Richard Clarida, said the central bank will stay in the game until the recovery is well and truly complete. Well, when is the recovery complete? They're going to push it out for as long as they can keep the economy booming. I think that means they're going to keep doing it forever until they can't do it anymore. And then one of the heads of the head of the San Francisco Federal Fed, that's one of the sub-branches of the Federal Reserve, that was Mary Daly, the San Francisco Fed president. She said, she was really blunt, we are not going to take this punch bowl away, okay? Getting everyone drunk on cheap money, all right? Now, and government, government wants to continue doing that. The American government is looking at plans to spend more and more money into the economy that it borrows from the Federal Reserve. The Federal Reserve prints up the money, lends it to the central government, which then spends it on public works and welfare projects. Currently, the American government, the Biden government, two projects. One is a green infrastructure bill, spending money on green projects and infrastructure. The other one is children and welfare. Liberal senators push Biden for $10 trillion climate and infrastructure bill. That's for $10 trillion over a decade. The GDP of America is about $21.5 trillion every year. So about half GDP getting spent just on that one bill every year. Okay, and that is what they're pressing for. Currently, what the Biden government is saying they're going to do is they're pledging to invest $2 trillion over 4 years for climate change and infrastructure, and Liberal senators are saying, no, we want you to increase that by 2.5 times to $10 trillion over 10 years. Okay, now what this article, the National Review, it's a conservative. To reiterate, even before Biden was sworn in, the nation's debt had eclipsed the size of economy for the first time since World War II and was on its way to smashing the all-time record. Then Biden added 1.9 trillion in new spending. I have no idea how much 1.9 trillion is. It sounds like a lot of money to me. Now he's expected to propose 4 trillion more, which will only be partially offset by tax increases. Yeah, it's not going to get paid by taxes. It will get paid by borrowing. So the Federal Reserve will sell a bond to a bank, which will then sell it to the Federal Reserve, who then hold it on their balance sheet. Okay, who then print the money and lend that money effectively to central government. So central government debt will go up. That is how it's going to get paid for. Increased government debt. And that's being reflected. Those are specific measures, and that's just one of those two big bills. The second one is going to be the Children and Welfare Bill, and who knows how much that's going to contain. Now, the philosophy of American central government is that government is the engine of the economy. It's not business, it's not private enterprise, it is government and government spending. Now, if you look at this article in the Wall Street Journal, behind Biden's big plans, belief that government can drive growth. Multi-trillion-dollar spending program would reverse Reagan-era tacit understanding that public sector is less efficient than the private in allocating resources. And if I go further down the article, the administration's sweeping plans reflect a calculation that the risk of doing too little outweighs the risk of doing too much. Yeah, we're going to really go for it. We don't mind if we do too much spending either. And the White House National Economic Council Director Brian Deese, we're going to be unapologetic about that. Government must be a powerful force for good in the lives of Americans. That is unequivocal. That is the government's philosophy. It is government that drives the economy by borrowing money and spending it. I think we're going to see a lot of that. Now that seems nuts to me, but I think it is. That doesn't mean it's going to stop. Well, first of all, the reason it's nuts is you can't keep borrowing and spending forever. The historical ceiling for that is when the annual deficit, so the shortfall every year, year by year, hits 20% of GDP. And now, where are we at the moment? Well, if you look at this site, US Debt Clock, it's quite fine. It's got a lot of statistics there. I suspect it's fairly middle of the road. I think Biden's lot would say it's conservative, it's alarmist. I suspect it doesn't show various things like local government debt or things that are paid for on the never never. What it says is this one I'm interested in, US federal budget deficit actual, is they calculate it at being about $4.5 trillion and rising. Well, GDP in America is about $21.5 trillion a year. So $4.5 trillion is about between 20 and 21% of GDP. So that's the deficit. The annual deficit in the States is currently already in the red zone. And central government, the American government, is looking at taking on more debt year by year. Now, I think America will defy that historical limit, that 20% limit at the moment. I think the reason it will go further than 20%, well, it's already gone further than 20%. I think that the ceiling is with America now is likely to be 30 to 33%. So that government spending will be able to increase until the annual deficit hits 30 or 33% of GDP. The reason I think it can get pushed out so far is because there's basically so much confidence in the American economy, particularly in the dollar as the world's reserve currency. People have confidence in it and they think that it will continue to be healthy. And as a result of that, I think that situation is likely to continue. The thing that will bring it down is either inflation or the belief suddenly when lenders say to themselves, why are we lending money to a bankrupt government that can never repay that money? That's a bad idea. What lenders are doing is they're lending money to government knowing the American government can never repay it, but knowing there are other third parties out there who will come and buy that debt off them. So if you own a bond, the government is never going to repay that bond, but someone else will come along and buy that bond off you or borrow more money that the government can then use to buy the bond off you. But at some stage, reality will hit those lenders and they will say, this government, the sheer amount of debt is too much. We're not going to lend any more money. And actually, the money we've lent them already, we now want that back. And that could happen if inflation came, because inflation would increase interest rates and it would mean the government couldn't even service its debt. It couldn't pay the interest on its debt, which is currently what lenders, people who lend to governments, banks who lend money to governments, what they're interested in is, can the government pay the interest on the money? But there are plenty of people saying that inflation is around the corner. I don't think it is. I think government will be able to continue to keep, or central banks will be able to continue to keep printing money and lending it into the economy, lending it to central government, because inflation is likely to remain low. And a good economist that I've looked at on this is a fellow called Lacey Hunt. He's an American economist. I have no connection with him, no investment with him. I'm sure he'd be disgusted that someone like me reads his stuff, but I don't care. This guy is he's a good economist. And he's been proved right over the years as well. He has said no, inflation over the last decade. He said inflation is not going to kick off when you get an increase in debt into the economy. It acts as a drag on that economy. That reduces the productive effect of the economy, and that reduces inflation. It creates deflation. Now, if I zoom in here, this fellow Lacey Hunt, you can look at his quarterly. He puts out a quarterly newsletter. It's Hoisington investment management. I'm not recommending them, I don't know anything about them, but this fellow's a good economist. He puts out this newsletter every quarter. It's worth reading, it's nerdy stuff. But basically what he's saying is that the disinflationary, deflationary consequences of debt levels conform with scholarly research from the 19th century. And it says that it indicates that high debt levels undermine economic growth. So where a lot of people have been saying all that money getting printed and lent into the economy is going to create inflation, he's saying no, it reduces growth, it reduces inflation, it creates deflation. And this research indicates that the negative effect begins when gross government debt reaches 40% to 50% of GDP, and the impact rises steadily as the ratio of government debt to GDP moves higher. At the end of 2020, gross US government debt reached a record of 129.1% of GDP, with new peaks reached in all major foreign economic countries. So what he's saying is the more money gets lent into the economy, the more that acts as a drag on the economy, which makes sense to me. If I take on a load of debt, I'm going to be really careful next year. I'm going to spend less money next year because I've got all this debt overhanging me. I've got to pay interest on it. I've got to pay back the debt. I'm going to get more cautious. More debt leads to slower growth. That leads to lower consumer price inflation, but much higher asset prices, house prices and share prices. But things you buy in the supermarket, they're not increasing in prices. The inflation in those is not going up. Your pay is not going up. And you'll also get more government action because there'll be more government action in order to try to create more economic activity, and in order to do that, governments will borrow more money. So you will then get more debt, which will in turn slow growth even further. So this process of ordinary people not seeing their wages rise, but capital assets increasing as governments borrow more money and spend it, that is likely to continue because governments are determined to do it, and inflation is not coming into play in order to put a stop to it. So interest rates are going to remain low. If those interest rates remain low, people will say, well, I can continue to lend to government. Interest rates are low, government can afford the interest on the money. It doesn't matter if they can't pay it back. That is likely to break at some stage. I think that will break when government debt each year, the deficit every year, the shortfall every year, reaches about a third, 30 to 33% of GDP. At that stage, I think people will say, no, I'm just not lending any more money to government. This is nuts. No one is going to buy this debt off me knowing that government is so up to its neck in debt. I'm just going to it's too risky to be in this market of lending money to government. People will start getting out of it. At that point, I think that central governments will have to move from printing money and lending it into the economy, lending it to banks who then lend it to businesses and to government. Central banks will have to move from that printing and lending to printing and spending, where central banks simply print up the money and just give it to the government to spend it on various projects, or just spend it into the economy. That's sometimes called monetizing the debt, or it was referred to as helicopter drops of money. You just print this money like confetti and just spray it and spend it into the economy. When that happens, inflation kicks up fast and it gets out of control fast. I think that is likely to happen in about 5 or 6 years' time. And when that happens, I think you'll see the economy unravel. And that will then cause the welfare state to unravel, which I think will in turn cause the authority of the state to unravel, and the state authority itself, the state, to unravel. When the state unravels and collapses, then I think the multicultural craziness that is an integral part of every part of government activity these days, that will fall over, that will disappear, because the governments that are promoting and enforcing it, they will no longer have any power because they will have collapsed and broken down. And then we will be forced onto our own individual mettle without government to protect and feed and potty train us. And then you will find when people are forced onto their own individual mettle, people will make sensible, rational, dry, unsentimental decisions, and they will want nothing to do with the PC multicultural craziness, and people, we will then start to undo the PC multicultural problems that have been created over the decades. And I think these problems will get solved, but not until then. Not, I think, for another 5 or 6 years' time, just a little bit after the midpoint of this decade. So this will get solved, but not for years to come. You are in this for the long haul, whether you like it or not.